Hey, Andrew. Yes, good morning to you. So we've got revenue coming in here, 21.6 billion. The forecast 21.8, so fractionally behind on that number. The EPS of $1.03 looks ahead of consensus, which was 77 cents. But there's quite a lot under the surface here to break down. Firstly, the provision for credit losses is a benefit, like with JP Morgan yesterday. That's 2.2 billion. And just a very, very broad range of estimates there. Always very hard for analysts to come up with a number there. So that flatters the bottom line a little bit, though, of course, a very positive position to be in versus last year to be releasing from these areas. But there's also a one-time deferred tax asset revision because of the corporate tax rate going up in the UK. That makes that deferred tax asset more valuable. And that's worth 2 billion. I think that number is going to be a lot more than analysts expected, and therefore, again, probably flatters that EPS number relative to expectations. So that $1.03, 26 or so cents better than expected EPS number perhaps won't be as rated by analysts as it looks on the surface. A couple of other things just to point out here. Expenses, which is always such a key area for Bank of America over the last decade, but including over the last couple of quarters, that comes in bigger than expected. 15 billion. The forecast was for more like 14.1 billion. Now, they have pointed out there that there's a one-off item of 800 million, including 500 million donation to the Bank of America Charitable Trust, the charitable initiative. So it's about 900 million higher than people were expecting, but they're saying 800 million of that is one-off. So we have to dig into that because expenses, if they're recurring and higher, will be seen as a negative. Net interest income. That's come in at 10.3 billion. I think forecasts were for a bit higher than that, about 10.6 billion. The margin there, net interest margin, key area for them, of course, very rate-sensitive bank, 1.61%. That's down from 1.68% in the first quarter. We're expecting it to tick down a little bit because of what yields did in the first quarter, but perhaps that has ticked down a little more than expected. In terms of the capital markets, investment banking, 2.1 billion, a little bit of ahead of expectation of 2 billion. Fixed income trading, 2 billion. That's a little behind the forecast, which was for a bit more than that, down about 40% year over year, similar to JP Morgan and Goldman Sachs in terms of year over year decline there. Equity trading, 1.6 billion. That's ahead of expectation, which was 1.4 billion. That's up 33% year over year. In terms of the year over year comparison, I think that probably puts Bank of America at the best on equity trading. Yesterday, Goldman was down a little. JP Morgan was up a little. They're up 33%. But quite a lot to break out here. Not surprised, actually, to see that share price decline a bit as these numbers have come up down 3%, particularly because of the expenses a bit hotter than expected and the net interest margin a little bit more disappointing than expected, despite the headline EPS looking good. There's a lot to unpack there, guys.
Well, that's what I was going to ask you, Will. If we're looking at the stock, as you just noted, we're down now nearly 3% on this news. Is it the net interest margin? Is it the expenses? What do you think was not baked into the cake? Because we had a number of analysts come on, even in the past week, it seems like almost expecting what you just said.
I think it was both of those two things. I think that expenses, which have been absolutely key to them over the last 5-6 years when Brian Moynihan has really delivered for this bank, expenses always top of the agenda every single quarter. And I think people don't mind if expenses is a one-off, if it's pandemic related, but they need to get on the call to make sure that's the case, because this number, 15 billion, is ahead of the expectation of 14.1 billion. As I said, there's a line in there that says 800 million of that is a one-off. But I think until they hear that clearly from Brian Moynihan, that, for example, they're not adjusting their full year forecast for expenses for the next couple of years, then I don't think people like to see the expenses number higher than expected. And then, again, net interest margin, 161 is a little bit lower than what people expected. We expected it to tick down because of what yields have done, but I think it's ticked down a bit more than expected.
Shepard Smith here. Thanks for watching CNBC on YouTube.